the number one TSP feature we hear over and over again from federal employees is low fees. And of course it is. Why would anybody want to pay more when they get something for less? While the low fees are great, and I agree it's one of the best features that is in the TSP, you have to be looking at the responsibility this puts on you as the federal employee to make sure your investments are doing what they should. Today, we're going to take a closer look at these responsibilities and what low fees actually mean. Welcome to Financial Planning for Feds. My name is Ed Smith, President of Valor Wealth Partners. We are dedicated to educating federal employees on how to maximize value from their government benefits by developing and executing a financial plan. So let's get right into what these low fees mean. When we're looking at low fees or fees in general, we want to look at two different sides of the investment fee structure. The first one, which most people talk about when they're looking at low fees, is what's called an expense ratio, or the operating cost of the investment itself. The other cost is the management of those investments. Let's first look at this expense ratio. Now, the TSP overall has a gross expense ratio of 5 basis points. Well, what does a basis point mean? That's a strange terminology. Basically, 1% is 100 basis points. So when I say 5 basis points, it's 5% of 1%. I know this is a confusing term, and it took me a while to understand it as well. Hopefully, the diagram has helped you a little bit. If you have any questions, send a comment and we'll try to do our best to explain a little bit more. So as I said, the TSP has an average expense ratio of 5 basis points. According to the Investment Company Institute 2017 report, the industry average for a hybrid mutual fund is 70 basis points. Let's first clarify what I mean by a hybrid mutual fund. This is a mutual fund that is both stock and bond. We wanted to give a fair assessment of the overall market. So again, TSP 5 basis point, the industry average 70 basis point. Well, what does this mean? Does this mean that the industry in general is just taking too much money from investors? Not necessarily. The difference between them is how they're invested. In the TSP, you're invested generally in an index. Let's take example of the C fund. The index that they're using is the S&P 500, or 500 companies in the U.S. stock market. Because there's no management of the portfolio and you're just following the index, the only cost is the fund itself and some occasional trading to make sure you have the right amount of investments. On the other side of the equation, when we're talking about the industry average, some of the reason why that cost goes up because the companies are doing research of what investments to be having. The research costs a lot of money, but it's also the committees that decide when and how to trade. How much should they be getting into? How much exposure should they have? So there's a lot of research that goes into it and a lot of manual effort that costs us money. So you have to look at that one side, you don't have a lot of management. The other side, you might have a lot of management, and that management costs money. It's not saying either one is good or bad, and you should realistically have both. There's times to really reduce your cost in a portfolio, such as when you're going to be investing in the U.S. market and the S&P 500. And there's other times when you might want to have a little bit more of a specific type of an investment, or areas where there's inefficiencies in the markets. Those could be small company funds, bonds, or maybe even international portfolios. All of them have different slivers where you could take advantage of the markets and find out where they could be doing better for you. They all have their pros and cons, and in a very well diversified portfolio, like I said, you probably should have both. But it's up to you, and one of the ways to reduce your cost is just to go with the index and make it very simple. Hopefully, you've understood a little bit more about what this expense ratio is and what we mean when we're talking about low fees in a TSP and overall portfolios. But the low fees isn't the only factor. Remember, we talked about the management of the portfolio, so let's take a closer look at what that means for the portfolio that you have. Generally, the management of the portfolio is guiding what investments you should have, when, and how much. One of the factors that you look at here is risk. Many people look at risk one time, set their portfolio, and forget about it. This is generally not the best thing you should be doing. You have a responsibility to make sure that your risk is aligned to what you want. A perfect example of this is the stock market goes up and down on a regular basis. One year you might be very optimistic of the chances of the stock market in general, and the next year you might be pessimistic and you might be very concerned of a crash. Because of these differences in risk, it affects what you should be doing. And if you're overweight and the stock market does crash, that means it's out of line with what your risk assessment is. The way to be able to look at this is on a regular basis, take an evaluation. For our clients, we use a program called Riskalyze that helps set a risk number, and we can invest accordingly to what that is. But whatever you choose and however you do, you should be looking at this risk to make sure it's aligned at least once a year for you, sometimes even more frequently in volatile times. Another area is the allocation itself. Over time, the portfolio shifts. Even if you're at an appropriate risk level, your portfolio may grow in one area more than another. Let's look at a growing stock market. If the stock market grows very well over 10 years, it is very likely that you will be overweighted in stock investments and underweighted in bonds, which means you could be at a very high risk. And if the market crashes, you are overweighted and you will lose more money because you didn't reevaluate your portfolio and check the asset allocation of your portfolio and make sure it's back on track. One of the ways to protect against this is the life cycle funds. The life cycle funds are very good for making sure that you maintain a certain allocation. But even though you can maintain this allocation, you have to be going back to that first part, which is risk. The life cycle funds are based off the year that you retire, or more specifically, the year you feel you will take money out of the TSP. So let's take, for example, the year 2035. Not everybody that retires or plans on taking money out in 2035 is exactly the same. Some people are more aggressive, some people are more conservative. Some people have saved more money and some people have not. So because the difference is, the 2035 fund or the life cycle fund itself is a good starting point for risk, but it doesn't mean it's the most appropriate for you. You again should look at a risk assessment to make sure that whatever year is perfectly aligned with where your risk is. And then again, reassess to make sure that follows over different years. Because the life cycle fund will back off of risk over time, it still doesn't mean it's the right one for you. Another way to do this is to manage the portfolio yourself. With this, the responsibility you take on is to make sure that the portfolio is being adjusted on a regular basis. Because if it's too much stock and it should be not as much because it shouldn't have grown as much, you should rebalance it back to the right level. When you're looking at the allocation on the portfolio, one of the things you have to do is when you shift that portfolio in the TSP, making sure you're changing both the future and the current allocations so it is addressed appropriately for what you want. I have seen many examples where people changed one and forgot to change the other. They might have changed the future allocation and the bulk of their money, their current allocation, was never adjusted and they are way out of alignment. Things that they had thought they did 5 years ago and nobody double checked them, they were a lot more risk than they should have been. So again, the low fees don't affect this because it's your responsibility to make sure that you're managing your portfolio both on the risk and the allocation. Another factor you have to be able to look at is your life in general. What I mean by this is, just because you have low fees doesn't mean you should put all of your money into this investment. There's other ways to get low fees. There's a lot of companies out there that can be very close to the TSP low fee cost structure. But if you overinvest in the TSP, you might hurt yourself on some of the life goals that you have. Let's say you want to buy a house, buy a new car, put kids through education, go back to school yourself. If you put too much money in the TSP, you might not have the money to pay for those things. Or you might have to take a loan or a penalty to take that money out just so you can fund the things that you want in life. So you have to look at other factors than just the low fees and what you can be able to put in the TSP. Other things you want to be able to look at is the tax sensitivity investments and how you're managing them outside the TSP and how this all works together. Like I said, there's a lot of portfolios out there that you can help you manage at a low cost, but the TSP is one of them that people just think is the only way to be able to do this. As we wrap up today, I just want to share that the TSP and the low fees are incredible. Please take advantage of them, but make sure you're looking at your risk, the allocations, looking at alternatives out there that you may be able to invest in, and then also look at your goals and dreams in your life and making sure you are not putting too much money into the TSP. Most people can manage the TSP themselves. But if you don't want the responsibility of managing your investments, then you should hire somebody that can be able to come in and watch those investments and make sure on a regular basis it's doing what you want it to be able to do. There's a lot of different cost structures of how you can hire somebody. In other videos we talk about them, so please make sure that you watch them so you can understand how you can hire somebody if you don't want to take that responsibility on for yourself. Thank you for your time today, and we look forward to the next video where we can educate you more on the TSP.